Ladies and gentlemen, are there too many treasuries? It seems like it. And that's what you hear in the mainstream financial media. You'll also hear that because treasury prices are falling and yields are rising, that's putting emerging markets at risk for a full recovery. We're going to talk to Jeff Snider, head of global research at Alhambra Partners, whether or not that's correct. Jeff, I'm going to read a quote right now from who? From who? From someone. Do you mention who it is? I'm going to read it, and then you jump in. You tell us who it might be. Okay. It's consistent with conventional assumptions, you say. Quote, the yield on the benchmark 10-year note nudged up to 1.557%, having peaked at 1.626% on Friday after Tuesday's auction of $58 billion in the US 3-year notes was well received. Yet many market investors remained wary, with the next test of investor appetite for the government debt due later in the form of a 10-year auction, and then on Thursday, a 30-year auction. This falls under the thesis of there are too many treasuries.
Yeah, that was a quote from a recent, I believe, Reuters article, which was simply echoing the idea that, you know, the government is auctioning off a lot more of debt because of everything that's happened over the last year or so, and that there has to be a limit to the amount of supply that the system can absorb, that there's just not going to be enough demand to meet what the government is supplying to the marketplace, not just the bank marketplace, but to the financial public in general. And maybe that's why we're seeing interest rates rise at the long end of the yield curve, because the government has finally surpassed the magical threshold where the market finally says, we're now bond vigilantes for the first time in 30 years or so.
Well, they've had a couple of opportunities already, as you describe in your article, quote, what gold says about UST auctions, posted on the 10th of March at Alhambra Partners. You say, well, this isn't the first time we've heard there are too many treasuries argument. You say that it was first brought up in 2016 and then later as well in 2018. And there was like a key or what would the word be? The thing that makes it go forward. What is it? The story, the budget, right? The fiscal budget. That was the
deficit.
That got the, yes.
Yeah, the deficit. Even though back in 2016, when this story first emerged, there wasn't really the same fiscal issues that we had in 2018, certainly, because 2018 was in the wake of the Tax Cut and Jobs Act, which had greatly increased the deficit for the first time since, I believe, 2013, 2014, somewhere around that period. So 2016, when we started hearing this about too many treasuries, was kind of odd because it wasn't a supply issue. It couldn't have been a supply issue. And what had been going on at the time was that treasuries were being, the banking system, the primary dealers had been loading up on treasuries, and that just mystified people, especially people who are quote unquote experts in the mainstream media who couldn't figure out why. Why would banking system be buying all of these treasuries? Don't they know inflation's right around the corner in recovery? And why would they possibly want something that's going to lose its value substantially over the coming months? And so the answer was, well, maybe it's because foreigners in particular are selling treasuries and the banks are obligated to buy them back because of some duty to help out their foreign customers or something. I mean, there must be this convoluted reasoning why the primary dealers were buying up all of these treasuries, because it didn't otherwise make sense, given that Janet Yellen was so darn positive about inflation and recovery in 2016.
And what about 2018?
Same
taxes.
Thing, except at least there was a supply story. But, it gets back to what we've said all along. What I've said is certainly ever since, I believe I quoted myself in 2016, is the whole story is absurd, because we're asked to believe that banks are being stuck with instruments that they can't sell to the public at a time when the public overwhelmingly wants those things, right? In March of 2016, there was no shortage of demand for US Treasuries. So if the banking system had it all been stuck with these things, if there were too many of them, why didn't they just sell them to the public? Because the prices of US Treasuries were sky high, which meant that they could have easily sold them to people who wanted them, if indeed the banking system didn't, which then, of course, raises the question, maybe the banking system wanted them They didn't believe in the reflationary story or the inflationary story. And there might have been other reasons as well, including things like repo and collateral shortages and all sorts of other things where they could make money holding on treasuries themselves and renting them out to people desperate for collateral. So there are any number of reasons to not take this story at face value when it originally showed up. And when it made its reappearance in 2018 as a supply issue, it was equally ludicrous and absurd because at the same time, the same thing. If the banking system was being forced to hold too many treasuries, this time, not just foreigners selling, but also because they're duty bound to buy anything at auction. So if indirect bidders don't show up at a treasury auction, leaving the commercial banking system or the primary dealers to buy up everything else that's left at a treasury auction, if they're getting stuck with too many treasuries, we still have to ask, why won't they just sell them to the public? And of course, as 2018 progressed and then we got to the end of 2018 and treasury prices started to rise precipitously, this sort of explanation completely fell apart because, again, there was absolutely no reason why, if the primary dealers were being stuck with inventory they didn't want, they could not just dispose of it to a financial marketplace, the secondary market that absolutely wanted any number of them.
You mentioned the secondary market, and as proof of your contention that these were in demand, you show the primary market. You show several graphs of auctions for several maturities for different periods. We're looking at 2018 on these graphs all the way to 2021. And we see on the graphs here that there are plenty more bids below the going yield, meaning there's decent amount of demand for the securities. And Jeff, I guess the point here before we move on to part two of this section is, yeah, rising yields because of reflation, but not monetary inflation and economic recovery.
Yeah, and it's also not a supply. It's not the supply that's setting the secondary price, which is what dealers are working off of. They're gonna bid for auction at whatever they believe they can, in a pinch, sell to the secondary market, because that's really what a primary dealer's job is. That's the whole point of a primary dealer, is to stand between the primary auction and the secondary market, which is the financial public, because the government has an interest in selling off its debt smoothly. And if there are banks willing to warehouse those securities so that they can sell them off over time to the public, then yes, that's a system that works smoothly. And the way that the dealers do that is they gauge secondary market interest. They know what the secondary market will absorb because it's their business to know. And so if they're stuck with too many treasuries at auction, that would be reflected in their auction bidding prices, and we don't see anything like that. And so it's not supply that's driving treasury bond and note prices lower over the last couple of months. It's entirely your reflationary considerations.
In your title of this article, you mentioned gold, and you show a chart here. Does gold corroborate your thesis? It's come off the highs for over 2,000 down to 1,700. What does that mean in the context of our story today?
Well, gold is traditionally believed to be an inflation hedge, and that's not quite right. Gold is actually a hedge against the biggest errors, which could be anything. 1970s, it happened to be runaway uncontrolled inflation globally. You go back to earlier time periods when gold was fixed price, it became hoarded, which essentially meant that its price went infinite because of deflationary pressures. So gold is an error hedge. And over the last several years, going back much further than last year, going back into 2018 and before, gold prices have been almost perfectly inversely correlated with Treasury note, especially the 10-year bond. So as yields fell in 2018 and 2019, gold prices rose. Not because the market was saying inflation's rising like Jay Powell was trying to say. What the market was saying, both gold and Treasury, was no, there's something bad going on here. We're seeing another bout of deflationary pressures that could be significant. And so gold prices rose pretty precipitously as Treasury bond yields fell equally. And those two things make sense too, because the opportunity cost of holding gold, because it doesn't pay interest, is something like a safe instrument like Treasuries. So the lower US Treasury rates went, the more it made sense to hold gold, especially if you were a gold investor and believed that US Treasury rates were going to go low and stay low. So they've inversely correlated with each other over this entire time into 2022, where gold prices actually hit their high a few days after Treasury 10-year yields hit their low. And ever since then, they've been moving in the opposite direction. As Treasury yields rise, and as fast as Treasury yields rise, gold prices have fallen, and as fast as gold prices have fallen. So there's an inverse relationship there that tells us, again, gold is saying reflation, not inflation, or big error in that direction.
Move on to the second part of this section here. And there was an article that I received from a viewer of the show on Twitter. And of course, I'm a bad host and I didn't write down their name, so please forgive me. But they sent me this article which dovetails perfectly where we want to go next. And it was by the Wall Street Journal. The title is Unexpected U.S. Growth Surge Could Unbalance Fragile Global Economy. A surprisingly strong surge in U.S. growth will drive a sharp rebound in the world economy this year, but the strength of the American bounce could unbalance weaker economies, particularly in the developing world. According to the Organization for Economic Cooperation and Development, the rise in the U.S. government bond yields in response to higher growth and inflation expectations could spark capital flight from emerging economies where vaccine campaigns have barely begun and whose economic recovery is expected to take longer. I don't know, Jeff. It seems, no, right? I mean, we're all, what? The U.S. economy is doing well, and now so everyone's going to run away from the emerging markets. If we're recovering,
right? How can that possibly be bad?
All
right?
going to do it's.
Especially with a globalized economy that has been synchronized so much over the last several decades. If one major part of it is doing well, then usually you can count on other major parts doing well eventually. It all seems to go together in one direction or the other. So if the U.S. is legitimately surging along here, we expect that rising tide to start lifting all boats. But what you're saying is, it's a mainstream myth of how does the dollar move? The dollar's exchange value. Why does it rise? Why does it fall? And really, there's been all sorts of answers offered over the years, and none of them really reflect what actually happens. Most of them have to do with these ideas that go back a very, very long time to a system that no longer exists. So one of them is essentially interest rate differentials. If you believe that the U.S. dollar represents safe assets, and U.S. dollar safe assets are yielding very little, then portfolio managers will, especially fixed income portfolio managers, will search out returns overseas. And so the dollar will fall as quote unquote capital flows into other places reaching for yield. Consequently, conversely, if the U.S. starts to do much better and bond yields rise, which we're already getting into the interest rate fallacy territory, which is another contradictory convection. But either way, U.S. yields start to rise. That means the level of return on safe instruments, U.S. dollar safe instruments, is much better. Conversely, capital flows out of those reach for yield emerging markets and starts to quote unquote come home. And so we have the U.S. doing well that harms emerging markets.
And that's exactly how this Wall Street Journal article continues. What you just said about the standard textbook explanation, that shows up in the quotes provided by the OECD chief economist, Boone. So I'm not even going to read those because that's exactly what she was saying. The only other thing I would note here, Jeff, is you say that this may have happened already in 2018. Is that right?
Yeah, well,
something similar?
Again, what's going on here is people are trying to make sense of what moves the dollar. And it sounds intuitive. Oh, interest rates in the U.S. go up, then everybody wants to come back to the United States. But are really fixed income portfolio managers able to move the dollar in that way? And there's the other part of this too, that over the last 5 years in particular, finally, even the mainstream media and economists have realized that when the dollar goes up, that's not good. That's not a good thing. Go back to how this was talked about back in 2014, for example, when the dollar really spiked in the middle of that year. People were cheering, this is great. The U.S. dollar means strength and all these kinds of things. And it has been in the wake of all the evidence that shows when the dollar goes up, it's bad for everyone, that people are starting to try to put together all of these pieces. Yes, the dollar goes up. That's certainly bad for emerging markets. So what is it that's driving the dollar up that could make it bad for the emerging markets? Capital flows. It sounds like it seems to be. It sounds like it seems to be the thing that checks off all the boxes. Except it doesn't check off all the boxes, because when you look at historically what happened, even in recent history, going back to 2013, 2014 in particular, but also 2017, 2018, and 2019. What you see is that, yes, initially bond yields rose. In 2013, for example, during the quote-unquote taper tantrum summer, U.S. yields rose, and so did the dollar, and that created an emerging market crisis then. But then in 2014, interestingly enough, bond yields began to decline, and declined sharply, yet the dollar didn't decline. In fact, the dollar spiked in the middle of 2014, even as U.S. interest rates were falling. So this interest rate differential, portfolio flows, capital flows explanation doesn't hold water. The same thing again in 2018, where you had rising interest rates, rising nominal rates in 2018, the initial dollar spike in April and May of 2018, but then later in the year, yields started to fall, yet the dollar stayed high and actually went higher. So that can't be the explanation for what goes on. And just, spoiler alert here, what actually happens, what we're seeing is that, repo problems, dollar shortages, all these kinds of things. You can have a dollar shortage at the same time there is reflation in the longer end of the Treasury curve. Those two things are not mutually exclusive. And as we have seen time and time again, in the initial phase of reflation and whatever, these Eurodollar shortage episodes, that actually does happen repeatedly. You have reflation in one part of the curve where the other part of the curve says it's never going to be any more than reflation. And eventually that's what contributes to the dollar disease that harms emerging market economies.
The article that we were discussing is called Standard Textbook Dollar or Eurodollar Standard, and it was posted on the 8th of March at Alhambra Partners. Jeff, that wraps it up for today, but let me just wish you the best of luck with your upcoming Hedgeye Macro Summit. And I believe that's going to be freely available to people to watch. So good luck. Do you know what you're going to talk about?
We haven't discussed it yet, and I'm always amazed that they have such a really good lineup. I'm always amazed that they say, we want you to come in there. I almost think it's like, they bring in the guy that they all want to make fun of at the end or something, the comic relief for all these other serious professionals.
They're going to do great. I believe they're bringing you in because you might be one of the few people who isn't buying into the inflation recovery narrative. And so they're going to, sit you down and kind of look at you like, wow, look at this person.
Yeah, what's wrong with this guy?
Yeah. He looks normal. All right.
Yeah.
Well, I love their stuff. I love their product, and I'm sure it'll be a great show. You were on there once before, and it was a really good interview, and it'll be freely available. And we'll tweet it out when it is available.
Yeah, they always do good stuff at Hedgeye, and Keith McCullough is one of the sharpest people out there. So it's always good to even just talk to Keith. So it should be fun.
It will be. It will be. Have a great weekend.
Yeah, you too. Thanks, Emil.